In this chapter, we'll discuss about rural banking. So credit is one of the critical inputs for agricultural production. Okay, so why do people who are into agriculture need funds? Say they need funds to buy seeds, fertilizers, fodder for cattle. Okay, then those are the funds which they require for short-term period, usually for 1 year or 15 months. Then they also require funds for medium period, like 3 to 5 years, for purchase of cattle, agricultural tools and implements. And they also require long-term loans for purchasing machinery or tractors, land. Okay, so these are the type of funds which are needed for agriculture. So the sources of credit available to farmers. So usually the major source for people in the villages who are into agriculture, the major source is private money lenders and landlords. In fact, just after independence in 1951-52, their share was as high as 93%. Okay, the problem with those people are they charge very high rate of interest. Okay, they take, because people are illiterate in rural areas, they take promissory notes with fake amounts, higher amounts, and if they repay, they won't have any receipts. So they later they can say they have not repaid. So these are the reasons why government has introduced institutional credit. Institutional credit means commercial banks, cooperatives, RRBs, there is regional rural banks. So commercial banks usually provide short-term loans. RRBs also provide short-term loans, and then there are cooperative. We'll discuss all this in a later chapter, right? So there are primary agricultural credit societies. They provide short-term loans. Then there are CRDBs. They provide medium to long-term loans. Okay. Then there is NABARD, who provides refinance to all these agencies. So the main focus which RBI and government are following is the multi-agency approach. Because if you look at the history of agricultural credit, there were only two institutions earlier which used to provide credit to farmers. One was the agricultural credit societies, and other the land mortgage banks. Okay, later they were renamed as land development banks. So as we said, more than 90% at that time, at time of independence, was met by private money lenders. So government realized that the cooperative banks and societies alone could not provide this required credit. Okay, so they felt that commercial banks should step in, and of course that was one of the reasons for nationalization. And also commercial banks were asked to set up regional rural banks, okay, to help small and marginal farmers and rural artisans. So this multi-agency approach is what we are now following. So agricultural credit, only banks are not providing agricultural credit. So credit is provided in a multi-agency approach, where commercial banks, cooperative societies, regional rural banks, everybody are providing credit to the rural sector. So the multi-agency approach needs a specialized institution to coordinate all these institutions. So that is NABARD. NABARD is the apex bank in India for rural finance. We'll discuss more about NABARD later, but for the moment, remember that NABARD is the apex bank in India for rural finance, which coordinates the activities of all the multi-agencies. So the questions you have to prepare in this chapter are: what are some purposes for which funds are required for agriculture sector? We discuss this. What are the sources of credit available? Why did government introduce institutional credit? Or what are the disadvantages of informal credit such as money lenders we discussed? What are some institutional credit available to farmers? What is multi-agency approach? Why are commercial banks asked to set up RRBs? What is the apex bank for rural finance?